My name is Munaf. I'm a financial planner with Credit Mahura Investments. I've been practicing as a financial planner for over 10 years and I specialize in investment and retirement planning. This is my third video in a 6-part series that I'm creating on tax saving strategies at retirement. If you haven't watched the first 2 videos, you can find them on our YouTube channel. In this video, I'd like to talk about 2 investment methods to invest offshore and how the one investment method can be more tax efficient than the other investment option. Now, to use the method that's more tax efficient, you need to have discretionary savings. So technically, anyone can use the information in this video, but why I'm including this in my tax saving strategies at retirement series is because at retirement, one would generally have discretionary savings available. And in retirement, it becomes even more vital to diversify your assets appropriately because the assets that you've accumulated is all that you have. So it becomes essential then to allocate your assets in the most cost-efficient and most tax-efficient structures. Also, in South Africa, South African equities consist of about 0.5% of investable global equities that are available to invest into. So diversifying into markets outside of South Africa should be part of most investment portfolios. So the first option that I would like to talk about that one can use to gain offshore exposure is via a global feeder fund. A global feeder fund is a local fund that's based on a local investment platform, but it feeds into an offshore fund. And by doing that, it provides the investor with offshore exposure. But it is a local fund and you can use rands to invest into it. When you withdraw your investment, you also have to withdraw it into your South African account, which is unlike the second option that I'll be discussing, where you actually have the option to withdraw the investment into an offshore account and you never need to bring the money back into South Africa. But that's with the second option. The first option is via the global feeder fund, which is the more simpler, straightforward way to gain offshore exposure. The second approach is to invest directly offshore. So you exchange your rands for that foreign currency and then you invest into that offshore portfolio directly in that foreign currency. So the investment platform would be based outside of South Africa and the portfolio that you invest into would also be based outside South Africa and you're investing essentially hard currency into that offshore portfolio. So those are the 2 approaches to investing offshore. The one is global feeder funds, which is a local-based product where you gain offshore exposure through a rand-denominated investment. The second is where you use your discretionary foreign allowance or your foreign investment allowance and you transfer the rands outside of South Africa and then you invest in hard currency. You invest into the offshore portfolio. So let's look at an example where you're investing offshore using a global feeder fund. In the examples that I do, I'll use the US dollar as the foreign currency, as it is the world reserve currency. But in reality, you do have the option to select which currency you would like exposure to. Obviously, it's not every currency, but you can select out of some of the major currencies, such as the British pound, the euro. On some platforms, you can even select the Australian dollar or the Japanese yen. But in the examples, we'll use the US dollar as it is the world reserve currency. But possibly it won't be for long, but that's a discussion for another day. So let's assume that we have 1.2 million rand to invest, and we invest this into a global feeder fund. At the time that we start the investment, the exchange rate is 16 rand to the dollar. We'll assume a 5-year term, so we withdraw the investment in 5 years' time. In this 5-year period, we'll assume that the investment has earned 10% per annum, and we'll assume that at the end of 5 years, the rand to dollar exchange rate the rand is depreciated from 16 rand to the dollar to 20 rand to the dollar. The total investment value at the end of 5 years will therefore be 2,415,000 rand. The gain has come from two sources. The one is the capital gain from the increase in the value of the underlying investment portfolios, and the second source of capital gain has come from the rand depreciation, because that capital of 1.2 that you invested at 16 rand to the dollar, that was effectively exposed to the US dollar, is now worth more rands when you withdraw it, because the rand is depreciated to 20 rand to the dollar. So there's a gain that you also get because of the depreciation in the rand. So in combined, the total capital gain is 1,215,000 rand, which gives you the total investment value of 2,415,000 rand. If we look at the second option, which is investing offshore through hard currency now, so we convert the 1.2 million rand into US dollars. At 16 rand, we'll assume the same exchange rate, which is 16 rand to the dollar. We then get 75,000 US dollars to invest into an offshore portfolio. We'll assume the same growth rate as also 10% over the 5-year period, and also at the end of the 5 years, the rand to dollar exchange rate is 20 rand to the dollar. So the capital gain from the increase in the value of the underlying investment portfolios, that $75,000 that was invested has generated growth of 45,788 US dollars. If we convert that into rands now, because we're withdrawing this investment back into rands, and if we use the current exchange rate of 20 rand to the dollar, the capital gain in rand terms in the value in the increase in the value of the underlying investment portfolio is 915,000 rand. The capital gain that is come from that capital portion, your 1.2 million rand that you exchanged into US dollars at 16 rand to the dollar, and you're now bringing that capital amount of $75,000 back into rands, but at 20 rand to the dollar. So there's that 25% depreciation in the rand, which means that there's effectively 25% growth because of the depreciation in the rand. So there's a gain that you've got just from the depreciation. That 1.2 million rand now is effectively grown by 300,000 rand because of the depreciation in the rand. So if you look at the total capital gain, the 915,000 rand plus the 300,000 rand, the total capital gain is also 1,215,000 rand. So investing offshore using global feeder funds or using hard currency and investing directly offshore, the capital growth ultimately is the same. The difference is in the tax treatment. So with investing offshore via a global feeder fund, the total capital gain, the total growth is taxable. So the growth that has come as a result of the underlying investment portfolio is growing, and the growth that has come as a result of the rand depreciation. All that growth is treated as capital gains and taxed accordingly. So if we look at the calculation and we assume that this individual is in the 41% marginal tax rate, this individual has to pay SARS 192,000 rand and 825 rand as tax for this growth from his offshore investment. With investing offshore using hard currency, the growth that has come as a result of that 1.2 million rand initial capital being converted into US dollars at 16 rand to the dollar, and then being converted back into rands at 20 rand to the dollar, which means that that 1.2 million rand effectively grew to 1.5 million rand as a result of the depreciation in the rand. That 300,000 rand capital gain is not taxable. So it's only the 915,000 rand that is taxable. You do not get taxed on that 300,000 rand. So if we then apply the capital gains tax calculation on the 915,000 rand, the tax payable at the 41% marginal tax rate is 143,000 rand. So that's a tax saving of just under 50,000 rand. It is useful to know that if the rand had to strengthen over that investment term, then investing offshore using global feeder funds would be advantageous because the strengthening in the rand would have a negative impact on the investment in rand terms, and investing offshore via global feeder funds, the strengthening of the rand would reduce the capital gain and therefore you pay less tax. When investing offshore using hard currency, the strengthening of the rand will not reduce the capital gain of your investment. So that 1.2 million rand that you initially used to convert into $75,000, when you bring that $75,000 back into rands, but the rand is now stronger, so you will not get 1.2 million rand. Say, for example, because of the rand strengthening, you only get back 1 million rand. So the loss of 200,000 rand, you cannot use that to reduce the capital gain. That's a loss that you just have to accept. So when the rand strengthens, then global feeder funds is more advantageous because you can use that loss that comes from the strengthening of the rand. You can use that to reduce the capital gain. You cannot do that when investing offshore using hard currency. But keep in mind that over the long term, in all likelihood, the rand will depreciate against the dollar. So investing offshore using hard currency will probably be to your benefit compared to investing offshore using global feeder funds. Okay, that was my third tax saving strategy. If you have any questions or need any clarity, feel free to reach out. I'll share my next tip in the next couple of weeks. Till then, keep well. Goodbye.